Thanks for spending a few minutes with me today. This is Fiscal Therapy, where we have real conversations for thoughtful financial decisions. I'm Travis Flandermeyer with Lakeridge Wealth Management. Each episode is a calm, honest conversation about money, planning, and the decisions that shape our lives. Joining me today is Kristie Kiley, loan officer and veteran of the industry for over 25 years with Guild Mortgage. So Kristie, thank you for joining me today. I'm looking forward to the conversation on mortgages. Here we are. It's summertime in Albuquerque. It's certainly heating up outside.
Yeah.
And another hot day today. Along with that, I feel like this is the time of year where mortgage activity and home buying activity seems to kind of heat up also. Our intent with this podcast is to arm listeners with good questions to ask, better questions to ask. And so I thought today maybe we could cover some of the common questions that people come to me with. How's that sound?
Good. Sounds good.
Okay.
Travis, thank you for having me as well.
Of course. Thank you. So I think jumping into that, it's hot outside. It is now a good time to buy? That's a question I get. I'd be curious what your perspective of that is.
Absolutely. It's a good time to buy. Our market right now is not very competitive. So for a buyer to be out there shopping, they're not competing against other buyers. So when they're putting a bid on the house or an offer on the house, and they have options, to go in for seller concessions towards buyer's closing cost or interest rate buy downs, getting some repairs done by the seller on the house. So during this time in this interest rate market, it's not as competitive. So it's definitely a good time to buy.
That's something that I was kind of curious about, you say in this interest rate market, because interest rates are kind of what seem to catch the headlines.
Correct.
And, sometimes the questions presented to me about buying right now are more interest rate related, but you're kind of talking more about there's other factors than just interest rates when it comes to buying.
Absolutely. Interest rates, it's not permanent. We can always refinance your interest rate down the road when rates come down or depending on your financing. But when you're going in, the price of the house is usually lower in a higher interest rate market. So you're wanting to get in on the house being lower and then having those options for your seller to pay your closing cost or help you with the interest rate buy down as well. And so it makes it a good time. And then you have options for, to talk about doing some repairs on the house that need to be fixed by the seller.
Yeah. So don't make the decision based on where interest rates are necessarily.
Yes. It depends on your financials, but absolutely. It's a good time to buy, and you're not competing against everybody else that's going in for that same house that could drive up the sales price.
Yeah. So kind of when it seems like everyone's excited about buying, that might be when you're seeing more competition as a potential buyer, more likely to be
Absolutely.
in a bidding war or something like
Absolutely.
that. Okay. You mentioned refinancing.
Yeah.
So the rate that you get when you buy a house isn't the rate that you're locked into for the eternity of that mortgage.
Correct.
Can you talk about refinancing?
Right. So we are doing some refinances right now because rates have come down. And, we always say a good time to refinance is when it's financially saving you money. If it's getting rid of your private mortgage insurance that you have on the house because you've obtained equity in that home over the years. Or if you're saving from a half a point to a point more in the interest rate. Or maybe you're looking to provide upgrades to your house and you have some equity in there. We have options for, your cash out refinances to even sometimes keep the same rate because the interest rate market was higher back when you purchased the house, or to get a home equity line of credit. We have, over the last couple of years, some people have racked up some credit card debt with high interest rates, and we're taking out some cash from the equity of the home to help them pay off that debt to have an overall monthly savings. And then maybe you're looking to invest into your child's college fund or your retirement and you have equity in that house. It's a good time to take those funds out to start investing.
Well, and you mentioned, so I've seen it also for kind of like a cash flow perspective, which can,
Right.
You mentioned PMI. So
private mortgage insurance, getting rid of that mortgage insurance, or freeing up your cash flow, one, to pay off your debt that you've accrued over the years.
Okay. And then, oftentimes people will say, at what interest rate decrease should I be thinking about refinancing? Can you elaborate on that a little bit more
Absolutely.
also?
I think when you are saving anywhere from a half a point in the rate to a point, and it makes sense to do the refinance.
Okay.
At Guild, we will review what's best on your options and your short-term plans and your long-term plans and what will benefit you.
Okay. Now, what's your take? Another common, really, really common question I get is on 15-year mortgages versus 30-year mortgages, kind of that duration.
Right.
What's your take on that?
Just like anybody, it's specific for our specific buyer and our borrowers that are coming in and what their long-term plans are and what their short-term plans are. 15-year mortgage can have a slightly lower interest rate. You will gain equity quicker in the home, obviously, because you're paying a higher principal payment on that. Versus a 30-year, it gives you flexibility on your budget for your monthly payment because it will be lower and will allow you to maybe invest the additional cash that you have into an investment. Every client is different, and we always review which option is going to be best for them.
Yeah. Okay. No, I certainly appreciate that. And I'm always a proponent that if a 15-year prevents you from being able to save money into your 401k plan,
Correct.
You don't want to sacrifice that.
Exactly. Everyone has a different plan. Maybe you're trying to save for your kids' college and you need to put that money in an investment. That you can always refinance later down to a different term of your loan.
Okay. Now, we talked about duration on 10 or 15-year, 30-year. ARMs, adjustable rate mortgages,
right,
are also a consideration. So there's a lot of options out there.
Always. ARM rates right now usually have a bigger gap in the interest rate, but right now they're slightly lower than the 30-year fixed rate. When we're working with an ARM rate for our client, we go over what their plan is because you got to have a strategic plan. What are you going to be in this house for 5 years or 7 years, depending how long that fixed rate is on the ARM. Why are you looking for the ARM? Because when that ARM fixed rate and that ARM ends, it becomes adjustable. And we don't want to set our clients up in an adjustable rate market.
Right. Yeah. No, that's...
So it's specific to the client.
Yeah. But it can be, again, kind of a cash flow management option maybe for people who don't think that they're buying their forever home.
Correct. If this house is going to be, say, if we're doing a 7-year ARM and it's fixed for the 7 years and you're like, I know for sure we're going to be in this home for 7 years and then we're going to be looking to sell it.
When people shop for a mortgage, they've got a number of different options that they can go to. They could go to their credit union. They could go to a mortgage lender. Can you comment, what's the difference maybe? And why?
It's a good question when we get that as well. Mainly because of the products that we have to offer our clients. We have down payment assistance for our first-time home buyers that the credit unions do not have, down payment assistance for our non-first-time home buyers. We have our VA financing for our veterans, our USDA financing for rural areas, and and FHA financing. It's just we have a huge range of products, especially for our self-employed clients, that we have to look outside the box for qualifying.
Okay.
So the options of loan programs is a lot more with a mortgage lender than a local credit union.
Okay. And in that vein too, then perhaps that suggests that maybe 20% down isn't the standard that everyone would have to adhere to either.
That's correct. It's a huge misconception for sure on the 20% down. We have our veteran loans that are 100% financing and they don't have to put anything down. We have our down payment assistance programs that help the clients get into their first home without any money down. We have conventional loans that if you don't want to withdraw your investment and you want to keep it in there accruing money, you can come in with as little as 3%, 5%, or 10% down. It's up to you. You do have private mortgage insurance on those, but the small payment on that outweighs the interest that you're accruing and maybe in your investment that you would take out.
Yeah, when people come to us with kind of financial planning questions about this, I think that people's concerns often are about kind of stepping into a mortgage forever or making an irrevocable decision.
Right.
It certainly isn't that, with options to refinance or change loan structure even, right?
Yeah. A lot of our refinances are getting out of mortgage insurance because maybe they had a house that they didn't want to sell yet, and that was holding up their equity, and they only wanted to put 5% down, and then they can come in and put the additional down to maybe recast the mortgage, where you don't pay for refinance. We offer a free recast on our loans, and it just re-amortizes the loans. So it does. You're not stuck in that mortgage. There are always options to refinance, as long as we qualify all of our clients.
And is recasting kind of the common scenario where somebody does sell a home after making the purchase of the new home,
Yes.
and then they're going to put that principal toward the new home?
Correct. Yeah. So it's not a refinance. You're keeping the same terms of the loan that you closed on, the same interest rate, the same 30-year, 15-year term. You're just paying down the principal balance, re-amortizing, getting rid of the private mortgage insurance that was on there, and then lowering your principal and interest payment on there. So it helps them be a non-contingent buyer on a house. They don't have to be contingent on the sale of their house.
Yeah. I've actually seen recasting work out really well for people in the past, so I was glad you brought that up. I wasn't even thinking about that.
Yeah, I do enjoy. I love that we have that option for our clients, because it keeps them having to maybe draw money out of their retirement or their investments, and they know they don't want to move out of their house right away. They need time to move out into the new house and then be able to put it on the market. So it is a great option.
And you're probably a more appealing buyer if you're coming in without that contingent option.
Absolutely. Yeah. I mean, as a seller, you're going to look at a buyer that's non-contingent versus a buyer that is contingent on the sale of their home being sold.
I think we've covered a lot. Anything else that you'd like to add?
I think you covered basically the most of it.
Yeah.
So thank you.
Yeah, like I said, our intention here is to give listeners, empower them with more information than they may have had before, and to help them ask good questions. So
I always say, call us and let us know, and we go through, all of your financing options and to see what best fits you.
Okay. Well, again, Kristie Kiley, Guild Mortgage, thank you so much for joining us.
I appreciate it. Thank you.